Okay, looks like we're live. All right. Welcome everybody. Minus Investing Live. A little bit of a eclectic kind of impromptu show today. I did a show last week. I don't think a ton of people saw it. And then I actually unlisted it because I went and listened to it on the replay, and my mic settings were really screwed up. And honestly, like it was very hard, literally hard to decipher what I was saying in a lot of ways. So I've redone my mic settings, and hopefully it's a lot better today. So in some ways, this is meant to be a little bit of a kind of a test run of the new mic settings in some ways, but yeah. Olga, hey, nice of you to join right off the bat. FG or JXN? Well, obviously, I mean, I'm in FG, but we can briefly look at some JXN as well. I actually have because I'm going to talk about really the recent kind of stumbles in private credit, the bankruptcy with First Brands and all that, and Tricolor, and we'll see, because I actually haven't really given Jackson too much thought in regards to that. So has Jackson been pulling back in price? That's like, I guess, what I would say right off the bat. Because I mean, well, here you can see FG had a nice little pop on its earnings, which was great, and it felt really good. It was like, oh, maybe it was actually starting to turn around as a stock, and then very soon afterwards, in kind of early September, started to very precipitously tumble, leading into then also on Friday we had the little tariff day, but obviously it had been tumbling well before that. And here the blue line is the S&P 500, and then the green line is gold. So that's really kind of what I had on the chart here to kind of show, in some ways, the three things that tells the story of my portfolio and relative to the market this year. It's like, if you understand what's going on with gold and you understand what's going on with FG, it tells you a lot about it. So but I haven't actually looked at Jackson. Let's pull Jackson up. I know they were doing better throughout much of the year, but have they also been suffering recently? Maybe a little bit here in the early October, but not really, not as much. So they're doing a little bit better. Maybe they're less exposed to those particular areas of their portfolio. I haven't really talked about them, but Jackson in general, I mean, I like the company broadly speaking, but I haven't had exposure to them for some time. I did have exposure to them in late 23 into early 24, I believe it was. So I held them for a while, but I haven't held them for some time. Obviously, I've kind of doubled down more on FG. So it must be said, it's the payouts or just the lack of hedging, both for FG and Jackson. I don't know. Well, if I'm the decline with FG has to do with more about concerns related to the assets on their balance sheet because of concerns in private credit, and FG has significant exposure on their balance sheet to certain private credit originated assets. They have a huge partnership with for their portfolio with Blackstone, so that's one of them. So that's one of the things I was talking about. But it doesn't really look like Jackson's been dealing with exactly the same issues. I mean, it looks like they started to tumble a little bit in, like I said, the last week, but they're not experiencing the same issue. Where, for example, here I'll show you what I mean. If I pull Blackstone up, if I pull Carlisle up, if I pull no, TPG, when I say TPG up, if I pull that might be pretty much a good spread of them. Here you can see that these guys were kind of falling in unison since mid-September, whereas Jackson looks like it was kind of escaping a little bit. I mean, maybe it was starting to get pulled down, so maybe it was just kind of like taking some time for it. So we'll see if Jackson kind of pulls down over the next few weeks, then maybe they'll have a similar exposure. Like I said, I'm not 100% sure what the exposures look like on Jackson's balance sheet relative to these particular issues, which don't really have anything to do with the payouts or hedging. It has to do with just the actual asset allocation of the portfolio itself. But like I said, if I take Jackson off of this, you can see like this is very much in line here, right? I zoom out for the year, you can see like they have decent correlation, but they weren't like super in line with each other. But then suddenly in mid-September, that's when that happened. And I think it was September 8th is when like the first filings related to the bankruptcy, or I think it was maybe the first report came out about rumors related to the bankruptcy. And then it was like the 17th when the bankruptcy happened, I believe. And so now it's going in. And specifically for people who are not even 100% sure what I'm talking about, there was a bankruptcy of a company, First Brands, which, from my understanding, does receivable factoring for auto loans. Is if I read that correctly. So basically, what that means is they basically purchase up auto loans at a discount relative to like the actual value that the auto loan was issued at, and then that discount allows them to capture their profit. So that what this does is it allows auto companies to get the auto loans off their books by selling it to this factoring company, and this factoring company takes their time to actually then go and collect it. Oh, for auto parts, it was a factoring company for auto parts. Is that what it was? My apologies. Yeah, but it was factoring though, right? It is a receivable factoring though. But for auto parts, yeah, like I said, I might have some of the details a little mixed up because I'm not super specific on the company itself. Like this, I never even heard of this company before this whole issue. But then it was $11 billion, I believe, is the current number. That's the total amount of loan losses that's currently expected, $11 billion. And then that's spread around all throughout the kind of private credit space. And there isn't a whole lot of clarity on like who has what type of losses yet. I think there was like a couple of players that came out and fessed up to like a couple $100 million or something here or there. So there might be, they specifically sell auto parts. Okay. I could have sworn I heard people saying that it was like, there was receivable factoring involved. Maybe that's the other one. Cause like I said, there's Tricolor and First Brands. Maybe I'm confusing the two a little bit, but like I said, like it's a bond default. Well, I know it's a bond default, but the question I'm saying is like what was the cash flow specifically to fund the bond? It's like, is it the cash flow from operations from the business itself, or is it from the working capital asset, like liquidation of that asset? That's basically what I'm saying. But yeah, it was a bond default either way, which is why, like I said, it's relevant to FG because FG's portfolio is basically a bond portfolio. And a lot of their portfolio, it's like 15% of it comes from collateralized loan obligations, which are largely issued by private credit institutions. For FG in particular, Blackstone being the particular key one. So yeah, like I said, Pulling Up Jackson, obviously they look like they're doing a little bit better. That might be that they were just kind of escaping velocity for the short term, and maybe they're going to catch down in the midterm. But then if I put like say, let's put Corebridge up, which is another one of FG's competitors. They're kind of underperforming a little bit beforehand, and then in some ways it looks like they're doing a little bit better on the more shorter term period. And then I mean, you could pull a bunch of up there, but we can pull Met, which is a larger one that is in the space, but also is diversified into kind of other categories. So you could argue, yeah, see, they're not really as affected by it. So it kind of depends on like what level of exposure you have to those specific parts of your portfolio, because like those are competitors to FG in terms of the product that they sell specifically. But if they might sell the same product, but if the portfolio is sourced differently, that creates potentially a little bit of a difference there. So yeah, I don't know. Like I said, I might look into Jackson a little bit privately on my own, but I haven't looked at them super closely in well over a year. So one other thing that was actually kind of called to my attention before I really started looking into the private equity thing, it was kind of called to my attention also that there was an insider selling for FG. I can't remember what day exactly it was, but it was like somewhere around here in this week, which was a little bit interesting. I can't remember which director it was off the top of my head, but I'm pretty sure it was I can't remember her name, but the chief investment officer, which is a little bit interesting. It seemed a little bit suspicious, and I didn't really think too much of it at the time because first of all, I don't really pay as much attention to sales as I do to buys when it comes to insider transactions. I mean, it kind of depends on the history of the person. You know, you kind of try to take all those things into account. It's like if they're always buying and then suddenly out of the blue they sell for the first time, well, then maybe it means something. But in general, there's a lot of reasons that somebody sells stock, whereas there's only really like one or two reasons to buy a stock, right? So it's a little bit, there's just a skewed sense of intention of buying versus selling. So I don't pay attention to sales as much. And then second of all, the chief investment officer, well, I would consider that an important position. She hasn't really made a whole lot of significant insider purchases over the history of the stock yet. Particularly, so I didn't really, it wasn't one where I was like, oh yeah, I pay close attention to this person. But either way, she seems to sell ahead of time, which is a little interesting, especially considering chief investment officer is actually a position that's kind of relevant to this particular issue here. Yeah, no, I'm pretty sure it was the 18th, because I remember thinking it's like it was literally the exact same day as the peak for Blackstone, which wasn't the peak for FG, obviously, but FG's kind of had multiple, issues over the last year or so. So kind of interesting on that front, which, we'll see what happens with that, because obviously earnings is also coming up here in the next couple weeks to a month or so. On the 5th it was. So that's coming up pretty soon. And I was actually kind of looking at the valuation in terms of book value only last night. It's at its lowest book value since the regional banking crisis, which is kind of crazy to think. Kind of crazy, honestly. So you really kind of have to put it in that perspective. It's like, I mean, either this multiple back here was too bullish and not conservative enough, or you have to argue that the circumstance is just as bad, or the risk is just as bad as it was back then. Which, I mean, I would argue that the risk wasn't that bad back here, admittedly. That was one of the reasons I was doubling down pretty hard at this point in time on the stock in the first place. But nonetheless, and book value isn't a very useful metric for a lot of other types of companies, but I do think it is actually kind of a relevant metric for this particular type of company. Olga, I'm wondering, whereas FG is annuities, how come it's so exposed to private credit? They don't state the revenue portion of their private credit. They do. No, it's not the revenue that their private credit fund. That's what's on their balance sheet. They hold bonds that are sourced in private credit on their balance sheet specifically. And that's, I think, like I said, like that's potentially true for many of the annuity companies, but they sell annuities, but how they pay out the annuities to their customers is by holding bond portfolios. That's essentially what they have. And a lot of them are publicly traded bonds, but there's a significant amount of collateralized loan obligations, which are basically kind of similar to kind of like how a mortgage-backed security works, where it's like you're combining a bunch of little pieces of different mortgages together. For a collateralized loan obligation, it's like combining different pieces of loans from many different companies all together. And this is often done with publicly traded bonds, but in the rise of private credit, this has been significantly done through private credit and a lot of those players I was just talking about. So FG's balance sheet has like a significant exposure to private credit on it, but the revenue that it pulls in isn't from private credit at all. It's just that's one of the ways that they pay out their annuities to their customers is through income from private credit. And technically, I guess you could say some of that is in their interest income as well. But I would say it's really it's more about the balance sheet than the income statement. Olga says, I chose PSEC because they got rid of their CLO. Interesting. PSEC got rid of their CLO. Because, and technically, like I'm talking about in CLOs, but technically there's other areas where you can still get that private credit exposure. It's just CLOs kind of like one of the more common categories where it is. Like really, you should just look and see like, because like if they might like explicitly label something as a private exposure, and then they might also just have other types of loan tranches named in kind of other ways. CLO is just a very, well-known and understood term ever since, the Great Financial Crisis. In fact, let me actually just go to FG's balance sheet, and so I can kind of show very specifically what I'm talking about. Because that also might as well talk about it anyway, because we're talking about, that's what we're talking about here today is like, well, what kind of risk do we think actually exists for FG. Like, is this something to be concerned about? And I mean, it's something to investigate. I've been investigating it the last couple of days, obviously. So I wouldn't say it's no concern, but you have to look into it to really get an idea of it. And I would say it's not likely to be a huge concern. And who knows? Maybe I'll be super wrong on that. We'll see if we get a huge notice from them on their earnings call or something. But I've tried to kind of do the math about it because, like I said, there's about $11 billion in losses. And I don't think, like, if you kind of do the math on like where, how large the tranches are for the people who've already kind of claimed various pieces of the losses, it kind of implies that it's going to be very, very spread out. And so, like, I don't think that this specific loss would likely, if FG has any exposure to it at all, it's not likely to be some huge hit to their portfolio. It'd probably be a pretty fraction of a percent type situation, if at all. Like I said, there's honestly good odds that they don't really have any exposure whatsoever. But at the same time, it's really more that this highlighted a lot of concerns in people's minds about the quality of these assets broadly. So it's like, well, if they were essentially marking the value of these loans too high previously, well, then that suggests that maybe somewhere else in the system there could be other assets that are also marked too high and at too high of a value. Man, let me just like search for it. It seems to not be. Oh yeah. It's like normally I can kind of zip through it and just find the. No, I'm not trying to imply that they have bond exposure to First Brands. It's just kind of like considering what if they did. I actually don't really think that there's any real reason to think they do. But the technical truth is that I don't actually know. They theoretically could. It's just not likely, considering the size of the loss relative to the total amount of assets that are kind of out there in similar companies that are holding exposures to these spaces. It doesn't really seem likely. Yeah, I'm just kind of making reference to the current event because that's what we're discussing. Like I said, it's more about considering like what would be the next First Brands. That's really the question right now. That's what I think is causing the sell-off, is really people are looking at these types of companies that have these types of portfolios and basically saying, okay, well, they may not have exposure to First Brands, but who's next? What's the next one in line? That's where I think the serious question is. But like I said, I haven't looked super far into it, but from what I've heard, there's some concerns about like the management that was responsible for these things. So like it could be a little bit of an idiosyncratic event. So here, looking at, this is their investment portfolio as of year end 2024. So taking a look at this here, we've got hybrid securities. This is one of those other categories I was kind of talking about, where it's like, what does hybrid security mean? Technically, you could have some private credit exposure in something that's labeled as hybrid securities. So for FG, that's 1%. Non-agency resident, not there. Commercial mortgage-backed securities, not really there. Asset-backed securities, you could have private credit exposure in asset-backed securities, and that's 17% for FG right there. So that's 18%. You could say where there could theoretically be private credit exposure. And when I say theoretically could be, it does in both of these categories. That does not mean the whole thing is private credit. It just means that it could be. So you could, take your guess as to like whether that would be. Oh yes, UBS. Thank you for reminding me, Olga. UBS is one of the ones that I'm pretty sure fessed up to a few $100 million at least. I can't remember what their number was exactly, but I'm pretty sure UBS was one of the ones, but UBS, Jefferies, there's a handful of people that have already come out and said that they had exposure. And then, like I said, the people who came out to claim their exposure only summed up to maybe like 1 billion or something. And we're talking about $11 billion of losses. So, and it was big people, the big players that came out and claimed the losses. And so like, if you only end up with maybe like a quarter of the losses claimed by the big players, then that suggests that it would probably be very spread out amongst a lot of very, very tiny players, probably. Hopefully in a very diversified way, though there's probably going to be some tiny players that were over concentrated in some significant ways. We'll find out. I know, like for because like you bring up PSEC, which is good for them for getting rid of their CLL exposure, because I do know a lot of the business development corporations are are up to their gills in this type of exposure. So that is definitely an area where people are being hit. But anyway, continuing on with what I was saying. So that's 17% for the asset-backed securities. And then right below that is the CLOs, the direct CLOs for 9%. So for FG right there, that's 26% for these two categories, which are I would say might be like half private credit right there. And then, like I said, hybrid securities, which might be more of a fraction, maybe less than half. I don't know what fraction you want to give it to, but something like it might be more significantly less on that front. So maybe still only like 26%. And like I said, if we cut that in half, it may be like 13%. So you could argue, depending on like kind of what ratios of this is private versus non-private, you could see how FG would have like 10 to 15% of private credit exposure. And that's technically on the fixed maturity category. Technically down here, they also have limited partnership private equity exposure of 3%. So you could sort of say the same thing. That's private equity, which private equity doesn't have to be private credit. But I mean, they could be very potentially likely could be. But it's also listed in their partnership category, which is more of an equity stake. And so maybe not. And technically that would be an equity stake on the private credit fund rather than just having fixed income exposure to the private credit, which is up here. So even this would still kind of be a different thing altogether, even so. So, 15% is kind of how I'm thinking about FG's private credit exposure. It's like 15% probably or something like that. And then, you have to say, well, I mean, what's their actual exposure to first brands? Like I said, in actuality, I mean, probably zero. But if you wanted to assume that they had some sort of like market weighted exposure to it or something, like maybe if literally all 11 billion was completely evenly spread out amongst all people who have private credit exposure, well, then maybe that would be like, a couple basis points or 10 basis points or something, maybe to their portfolio or something. I don't know. It probably wouldn't be like that. So I don't know. We'll find out, because I'm sure people will ask them on the earnings call for sure, if they don't already give details on it in the remarks to the earnings in the first place. But it will certainly be a topic of conversation, because it'll probably be a topic of conversation for all companies that have similar exposures to this. So let's actually take a look at Jackson while we're doing the portfolio diving. Might as well. Please like the stream, by the way, if you're liking and enjoying the content. Subscribe to the channel if you haven't already. Share it around if you have places to share it to, people who would appreciate it. All of those things. Join the free Discord. Link is in the description below. It's also the pinned comment in the chat. Join our free Discord. You have to be manually added once you click on the link. So be patient with me to add you, or try to ping me to add you sooner or something. But come be part of our discussions there. So let's go find Jackson's. Let's see there. Investments. Like I tried to find but the same terms as FG, but it didn't really take me to it. These 10Ks are always a bit long. It can be a little annoying trying to find something if you're not super familiar. Revenues. Come on, just give me the portfolio. Oh, wait. Is this good enough? Doesn't have percentages. It's not really giving me super high detail. Keep going. Oh. Here we go. Here we go. Bit better. Yeah. There we go. Okay. So, listed at fair value. Other asset-backed securities. Commercial mortgage-backed will ignore. Yeah, no CLOs. They have the asset-backed security category, which for them is looking like, let's say it's 4 billion out of 43 billion. So that's going to be like, what, 8.5%, 9% or something. And then, like I said, asset-backed securities, you can kind of assume it might be like half that or something maybe. So that's maybe like a 5% exposure for Jackson is maybe what it looks like to private credit. So yeah, you can see how Jackson would get a lot less brunt. And then also, Jackson is larger too. So there's that factor as well. Larger market cap, larger, more stable float. So there's that factor as well. So yeah, you can definitely see how they would get a lot less punishment relative to FG. A lot more benefit of the doubt in the short run, potentially. But who knows? So they could start to catch up. But also larger means a larger percent chance that they do, I would say, have some exposure theoretically. But it also might be a much tinier exposure for them too, if that was the case, because they're larger. So, multiple ways to think about that. But yeah, so interesting. But yeah, so we'll be curious to see the earnings from FG. It was the case that they were a little bit on the weaker side of some of the sales figures in terms of kind of comparative to other companies' market share numbers for Q2. They were a little bit on the weaker side for some of the categories. They were good in some of the categories, but not necessarily in some of the stronger categories that you were hoping that they grow in. Where's this one? Yeah, fixed rate deferred, indexed, and then payout annuity. So an index, F&G. I think this was so sixth place in terms of the market share size for this in Q2. I think that was like a drop from fifth place if I'm remembering correctly. So that was a little bit disappointing. And then the absolute number was higher, but the absolute number in general was higher for everybody. So that's the thing, is they did well, but just not as well as some other players did. FNF as the parent, Olga brought up, why did you choose FG? Well, frankly, because FNF was the parent was kind of the reason I ended up with FG. I was an FNF shareholder when FNG got distributed out. And so that's kind of what made me do so much research into FG, and specifically is because I already owned them. And so I kind of just ended up doubling down further on them. And like I said, when I was doing a lot of that research into annuities and doubling down on FG back in 2013, I did in fact purchase Jackson as well, because Jackson at the time was even cheaper. They were just extraordinarily cheap, and they've really moved upward in terms of valuation to somewhat of a degree. I wouldn't say significant degree. Let me actually pull that up on comparison, because I think they are still pretty cheap. But the point is, I decided I liked the specific types of products that they did a little bit better. Let's get rid of the book value one. Yeah, you can see they were way down here at 1 to 2 times earnings, and so they're still really cheap, obviously. But it's a different type of product, and frankly, I'm less enthused about it. And I also really like the management of FG. But like I said, I still consider them more interesting. It's just they're not my preferred one for kind of the longer term. So as I was only just saying a moment ago, I might take a look at FG again. It was sort of a tactical trade, I guess you could say, at Jackson, whereas FG I liked more for the long run, and I've continued to like them for the long run, even though they've been punished pretty significantly. So yeah. In fact, let me pull up the. Do I have the So like here, let me move out of the way a little bit. Here I have, this is, so you understand the chart, this is trailing 50-day performance. So here, oh, you can't even really see the left axis, but it's percent change over the last 50 days. So that like the higher it is shows basically how big the last 50-day change is. So it really only shows you the very short term. But nonetheless, these are, in my opinion, kind of like the 5 that I would say are most comparable to FG in terms of the types of products that they sell. And each of them are like, slightly more comparable in different ways. Like, maybe one of them is a little bit more focused on index annuities. Maybe one of them is a little bit more focused on fixed annuities. Maybe one of them is a little bit more focused on pension risk transfers. It's a little bit of a mixture between it, but these are kind of the spread of competitors. So if you kind of like look at it, like, yeah, FG is underperforming, and really they've kind of been struggling at various points throughout the year. They were significantly underperforming following Liberation Day, and then they managed to catch up pretty significantly. And then after their earnings that they had, not catching up all the way to becoming one of the top performers, but then now they've kind of been falling back below. Though it's worth noting, one of the top performers at various points here, Corebridge, which is one of those smaller one that has very comparable products to FG, they've now become the biggest underperformer in terms of that 50-day change. If I was to pull all these up and look at them on like a year-to-date basis, which actually screw it, let's go ahead and actually just do that as well, because I like that chart because it's in my spreadsheet, so it kind of just automatically updates. I have a few spreadsheets like that for kind of comp groups of my companies, but let's actually pull a year-to-date one up as well, so that you can get an idea of just how poorly FG is doing right now on a year-to-date basis. Though, I mean, if you zoom out, if you zoom out a bit, then it's not as bad. If you go back to FG's IPO, I wouldn't count like literally from that first candle, because that's not really a very realistic candle. But maybe if you got rid of like that first day, then like this would really be like FG's performance to its comp group since IPO. But then yeah, on a year basis or a year-to-date basis, definitely on the weak side. But yeah, nonetheless, coming over to the that little spreadsheet I have showing kind of like the comparable group right here, and then also I have the second sheet right here that shows it against kind of like larger groups. So the deep blue, that comp average, is literally the average of those 5 companies. So it's literally kind of basically showing you one line that kind of combines all of those guys together. But then I also have the insurance ETF, as well as the financial sector ETF, as well as the S&P 500 here. Again, on that 50-day trailing basis. So on trailing 50-day basis, very, very weak. On a year-to-date basis, also very weak. I could throw S&P 500 in there. So linear charting. What do you mean linear charting? I mean, I'm not drawing lines on anything here. I'm just discussing how my company's performed compared to its comp group. So you really should kind of show you that it's like, yes, it's doing poor, but in many ways it's kind of in line with a lot of the industry stuff. Like the thing, because obviously I've been talking about it all year. A lot of these companies, I think, were bought up near the end of last year to somewhat of a significant degree based off of interest rate expectations, which obviously that happens a lot whenever there's larger interest rate change expectations. People do tend to kind of make bets on that a little bit. So people at the end of last year, people were expecting interest rates to come down a lot sooner this year. And I think a lot of that has been delayed longer than people expected. And this was definitely going to be a company that was going to benefit from a drop in the short-term interest rates relative to that. Linear, you mean like logarithmic versus linear on the charting? Yeah, those are all linear, but those are all relatively short time frames. I mean, I wasn't looking at anything longer than like a 2 or 3 year period there. So in my opinion, it's yeah, no, I prefer log charts on longer time frames too, but you don't really need that until you get to like, I'd say like 5 years or more at a minimum. I mean, really, I would say like 10 or more, honestly. But yeah, it's like if you're going to look at something a longer time frame, you really do want to put it in logarithmic. But in the short term, not so much. Don't really need to do that. Yeah, I mean, for example, with gold, for example, you can't even really look at a chart of gold without looking at it logarithmically. But like, for example, if I look at a 5-year chart right here, regular versus logarithmic, doesn't really change that much. And that's 5 years, right? Like, that's just not that much. But if you shift it to more like 10 years, it starts to be a little bit more of a substantial shift in terms of how it feels. But yeah. So on the gold front, though, I did want to talk a little bit about gold. Obviously, it's performing pretty crazily. Yeah, looking at the weekly is crazy. Like, just the consistency is insane. It's just kind of insane. Which, people often ask me, they're like, okay, well, I mean, you've been bullish gold for a long time, so like, where do you stop being bullish on gold? And in a sense, there isn't really an endpoint to the bullishness of gold, but you do sort of have to have like a strategy for what you're doing with your portfolio. And I did kind of already like institute that some time ago. Like last year and the year before and the year before that, I was holding gold, but I didn't really necessarily have a super big plan for how I was going to handle it. But now I do technically have like a sell strategy that is basically on momentum. That's basically what I'm going to do, is just kind of ride the momentum. And so once the momentum breaks, we'll get out. And if momentum picks back in, we'll probably get back in. But that's because, well, we do believe in the diversification power of gold, but obviously it doesn't have a cash flow, so you can't value it, and so you can't necessarily determine a high point or a low point based off that. And really, I think the only way to think about gold is actually more as an asset class, and to compare it as an asset class comparatively to basically other large asset classes and their size. And you kind of have to think like, oh, okay, well, what should what should the size of the asset class be relative to other asset classes? And in particular, I think like you could compare it to the treasury market, for example, because that's like really its larger competitor. But that's just like one aspect of it. But then I also have the exposure to the gold miners, which is really actually more of my exposure, because let's see, I have currently holding about 12% of my portfolio in gold. But then I have 7, 6, 13, 17, 20, and then I have like about 20 to 21% in gold miners, gold and silver miners. And so obviously those are cash flow instruments, so you do have to kind of consider that. But their cash flows become better as the price of gold goes up. But of course, that presumes that the price of gold is going to remain steady from there on the cash flows into perpetuity. So you do have to sort of think carefully about, well, what is the gold price you're using for the cash flows into those companies? It makes it a little bit more tricky to figure out. Olga, SPY gold to US dollar denominated. Yes, I mean, both of them are. That is the kind of the tricky part about financial assets in general, is you have to kind of always ask yourself, with what we're going through right now, it's like, well, how much of what's happening is due to just the monetary unit itself being debased over time, versus the actual cash flows of the business. And technically it's sort of a combination between those two, right? Which is why people often talk about like real returns. Real returns would theoretically be sort of the actual returns of the business production and the growth of profits, whereas then there's inflation inside of that. And then, well, obviously, and then you're talking about like a denomination of the dollar, which you can't like inflation adjust on the denomination. But what you could do is you could show SPY denominated in gold, for example. People do. That's a thing that people like to sometimes bring up. So like if we denominated SPY in gold, then we actually peaked back at the end of 2021. And that's partially because gold's been ripping so much. And then that's the local peak, because technically an even higher peak would be back in 2000. But you can argue also about the validity of using any such logic like that because, well, we don't actually use gold as money. As we use it as a financial asset, but not as currency. So exited all miners last week, you say, Olga. Well, I mean, I can only assume that you were in that ride for a decent while. So therefore, I can only assume that you are at least happy on your gains. Don't try not to look back. I always tell people try not to look back too much, which it might be difficult if you're watching my streams because I'll probably continue to talk about them. But fair enough. I mean, look at this. This has been a pretty impressive performance. The GDX was literally sitting here in a bear market for over 10 years, and literally just in the year, it's just exploded higher. And comparatively to that gold chart I showed you, I was going to show you how it had the consistency in there. So we did have a little bit of a red week here, which is interesting. Yeah, 8 to 12x. There you go. Yeah, so reasonable enough to get out. But you have to have some sort of strategy for it. But in my mind, the way I look at it is I don't really see a whole lot of other great places to put money on individual positions per se. It's like I could put more into FG. I was up to 20%, and because it's come down even more, I'm now down to like 18%. So I could put some more into FG. But that's the thing about these is I don't really actually find them to be particularly super overvalued. A couple of them I don't think are super cheap either. But they're not like super richly valued. And that's the thing is like, I actually do kind of want to hold them until I think they're somewhat richly valued. Though the story is a little bit and the strategy is a little bit different for each of them. And then Generac, I mean, I've talked plenty about Generac. It's one of my favorite companies in the market. And it was one of my favorite companies when it was still at like 200. And I said it was basically like fairly valued, probably at like 175 to 200 anyway. And so now it's dropped down closer to that lower end of where I thought value sort of was, which means it's only better. I only sold a tiny bit up there, so it's it hasn't been great for the portfolio returns in that way, but in terms of the forward expected returns, it's improved, right? So I'm satisfied with that. PayPal's been kind of going a little bit all over the place, up, down, and around a little bit. Like it was doing very good before the end of the year, then fell down pretty significantly with Liberation Day, recovered a decent bit, and then come back down. I don't necessarily want more exposure to it, but I don't think it's necessarily a bad value per se either. So that is what it is. Lennar, I've been happy with that one. Also kind of did a reverse course, which the home builders in general did this. They were being, this is because they're a strong rate play as well. So as people were expecting the rate cuts, there was a big buy the rumor and a bit of a sell the fact kind of scenario is basically what it kind of looks like right here. So I was actually kind of shocked that it had run up that quickly when it was up at 140. So not too surprising to be technically sure, but and there's a lot of struggles for housing. Like I think that they're a good position to be had, but I certainly understand why they're struggling this year. It's just one of those things where I've taken my position on that. And in mode has kind of been doing a little bit of a slight sneak up from the lows that it was at here in the 13s back in June, but obviously that's a small recovery from significant downtrend ever since 2013. It's just been struggling, but they have bought back a significant amount of their shares. That's one part of the story that I think a lot of the market still hasn't woken up to, and they're still kind of playing a reluctant role to that buyback machine. What with having an activist investor basically still continually trying to bully them into doing more. And I think that they will. It might take until the new year before they do the new buyback. I don't want to assume it's going to happen super quickly because they like to delay on it, but due to Israeli tax laws. So that might take a little bit of time on that front. But point is you're going to blink 1 year from now and they're going to have a significant reduction in shares once again. And it's one of those things where their business has still failed to come back to growth, but it still hasn't fallen apart to nothingness like a lot of the bear cases were arguing either. So it's sort of in between the bull and bear cases, which I'll admit it's been a very disappointing position for me. But nonetheless, it is what it is. It's like it's de-risked and reevaluated its valuation on itself. It's like it is a huge loss for me relative to my cost basis, and the worst position for me easily by a long shot. But not selling it when it's already down 30% necessarily. I just should have sold it a long time ago. That was the real truth to it. But And then Mastercraft is kind of an interesting one because it hasn't really gone much of anywhere, but I look at this and I'm like, well, if there was to be a position that I wanted to sell to maybe add to something else, like adding more FG, for example, this would be kind of a prime target potentially, because while I do think it's undervalued, it's not one that I necessarily have like a huge amount of like confidence behind like some industry theme to it and huge confidence in the management. In fact, it's somewhat new management. I just think it's a reasonably cheap stock, and that I got in previously. And in some ways that its story has also been revised in my mind, and it's been somewhat of a disappointment in that regard. And the Milrose, that one was one that spun out from Lennar, which has done very, very well. And actually had a little bit of a dip back due to Lennar trying to do a share transfer for their ownership of that. So I could theoretically sell this one too, but them together makes up basically like 3% of my portfolio. So I could sell this and add to FG, and that would bring me back to like 20%. And then, well, obviously I do have the index portions of my portfolio, but frankly, since I've kind of developed a separate macro momentum strategy for that, I sort of kind of want to leave that alone and have that be its own separate position, because I am trying to sort of determine whether or not I think that strategy actually can generate alpha the way the back tests seem to indicate it likely can. But it's one of those things where it's like a back test is a back test and reality is reality. So I'm sort of running an experiment there, and I'm I could make that position smaller, but at the same time, I kind of want to have that experiment run on a sizable position. So it is what it is. So those last couple comments from Olga, adding to energy stocks, land developers, housing, in parentheses, mortgages for that. Energy, I've definitely kind of wanted to look a little bit at some energy. Oil has been just cratered, but a lot of the big majors not necessarily as much so. So that's one of the things where it's like, when I typically look at a lot of the oil plays, I often am just looking at a lot of like the more major ones, and yeah, obviously they haven't gone anywhere. So you could argue potentially the valuation might be decent. I haven't really looked super closely at their cash flows per se. But so from that basis alone, you could say maybe that they're okay from that perspective, but they're not like going hugely downward in the same way. But that's just Chevron. Obviously, you could pull other ones up if you wanted to, whatever ones you want, but slightly different story, different ones. But obviously there's other ways to play energy too. You could be talking about more like utility plays, or you could be talking about equipment plays. There's other ways to play energy other than just the producer majors. Let's see, to anything housing related to rip hard next year, second half is my guess. Yeah, I'm sort of kind of in line with that perspective, is sort of my thinking too. It's like I've been watching a lot of the housing stuff very, very closely, because I mean, really this year I've been focusing a lot on economics broadly. To anyone who's been kind of paying attention to what I've been talking about, that's definitely the case. I've been just analyzing all sorts of economic data, and it's definitely hard to say, because like there's a lot of strong arguments for kind of the bear case in housing. I'll admit, like it is easy to make some strong bear cases, but I think that you really, if you look in a very nuanced way at a lot of the details, I think it's easy to understand why there's a bear case. But I think it's also pretty easy to see why we're actually potentially more like bottoming on the bear case. Like the bear case is passed and we're actually sort of bottoming. And it's one of those situations where it's like a lot of the data looks real rough, but I think it's about as bad as it gets. So like, for example, here looking at kind of the 10 largest major metro areas separately, not just like the index overall. I think it's like half of them now are in negative year-over-year growth, which is pretty significant. And then obviously, like, comparatively to the dark times of 2008, 2009 and all that, where we got all of them down there, but that's not necessarily reasonable to assume that we're going to get to that kind of same level there, because we didn't really get the same quite levels of speculative behavior in terms of the housing market this time around. We got some pretty hot activity going on, but it wasn't quite the same. So it's like, in many ways, like if you were to kind of compare this hump to this hump, and there's this dip to this dip, I sort of look at like this downward dip that we've been in right here is sort of like the retest we had in 2011, 2012. That's sort of what if I had to guess, where it feels like we are in the cycle, where it's like, yeah, it looks like things are downtrending again a little bit and it's rough, but it's like I think it's just because we had like a false restart again, essentially, at the end of last year, into the start of this year. So we'll see. We'll see what's going on with that. These are year-over-year changes. If you look at like 3-month annualized rate of changes, it kind of changes the story a little bit. But here I have a variety of data I can show on housing that there's this one. This one. So obviously, like if you look at like different versions of price indices, it kind of tells different stories too. So a lot of people are and the reason why, because like this is the 20 and 10 city CoreLogic index, which is kind of like the average of all of these, or at least the 10 city one is basically what that is. It's a weighted average, technically speaking. So you see it's in positive territory, even though like more than half of these were in negative territory as of the most recent month, which was July, the most recent month of data that came out, or maybe August is out. But you can see like on different metrics, you can get slightly different stories, like median sales price of houses sold, average sales price of houses sold, the national home price index versus the 20 city index versus the 10 city index versus an all transactions housing price index. They all kind of give like slightly different stories in terms of like how bad the situation had got and how bad it actually is. And I'd say the same thing for 2008, 2009. You can see like those all paint like slightly different pictures as well. And also in terms of like when the recovery, where things were in terms of the recovery. So like one thing like I think is like a very easy way to think of this is like if you really do think of like late 2022 into like the first half of 2024 is sort of like a hidden recession, like a shallow rolling hidden recession, then it kind of like explains a lot of the situations we're in. So going to these next charts, these ones are I've kind of constructed and I find pretty interesting and pretty valuable. So here the blue line is vacant housing units for rent. So these are units that are vacant and that are available to be rented. They're for rentability. You could currently go and to open a contract to rent the units as a percentage of the total units in the United States that are occupied by renters. So people who actually are rented. So the total amount of available rentable units as a percentage of the total amount of renters, generally speaking. And this one is on the left hand side. So here you can see that like back in 2001, it was at like 9%. It rose up to a high of like 12 to 13%. And then it's been downtrended ever since then. So you can see that there was tons of units available for rent. So way too much renting availability. So tons of units available for rent that were relative to the people who were renting. And that was one thing that had to recover post GFC. We're talking about the blue line here. And it had trailed all the way down. It got back to sort of around the 2001 level back around 2013, and then it went under. So when it went under there, that means it was now a tighter supply in terms of renting stock, tighter supply from 2013 down to 2019. And then you can see that it stayed tight through 21, 22 when we didn't have a lot of building, but we had high prices going up. And then the building stock has been growing, and that's what people have been worried about. And that's one of the reasons that housing is struggled so much, is because the building stock has grown so quickly. And a lot of people are concerned. They're like, oh, well, if we have growing inventories, are we going to end up in another 2008, 2009 scenario? Well, I would say, look at this chart. Does the blue line look like it's anywhere near it was going into the housing crisis? Nowhere near it. Nowhere near it. There's not nearly enough rentable spaces relative to the population of people who are renting compared to where it was there. And, you know, this doesn't take into account huge immigration changes yet. So there's that to factor in. You could say, well, what about that? Like, it's only been 2 quarters. Does this data really take that into account? And the truth is, no, that this data definitely takes like a year to really like calculate out the estimates. A lot of these are estimates, so it takes time for it to become more accurate. So the point is like, housing availability due to immigration changes, which you could argue could have an impact. That could have an impact, but it's not going to have a drastic impact. It would maybe raise this up a percentage point or maybe 2. So that would maybe get us back to kind of our average normal level maybe, but it wouldn't put us above average. And then the green line is units started 2 or more, which sort of implies that it's likely to be for renting. So private housing units started that are likely to be for renting relative to the actual total amount of vacant housing units for rent. So then, which is the numerator from up here. So this is the stuff that's going to be coming onto supply as a percentage of the stuff that is currently on supply. And so here you can see like coming down, down, down. That basically means that there's a relative to the total amount of on supply. That means there's a huge amount of on supply here, and then a lot of housing starts as the building starts to collapse. And that's one of the things. The building collapse happened well before the peaks of the total supply happened, and that was one of the reasons that we had a recession, is because the building collapse was the actual decline in GDP, was the builders themselves no longer being part of that supply, and then that itself led to the financial crisis as well. But here, looking at this, you can see like we had a peak level where there was a huge amount of building about to start to happen relative to the total supply, and then that itself has come down pretty precipitously as the building has slowed down and that supply has started to hit the market. And now we're actually back to sort of a normalized level. So the point is like for both of these lines, you would sort of want them to be normalized around the midpoint of the graph. Both of them being at the midpoint would be a sort of normal renters market. And this is, like I said, this is all renters market. Now I did the same thing with the buyers market. This is basically doing the same metrics, the same logic, but doing it with buyers data rather than renters data. So renters data, buyers data. And you can see it's somewhat similar, very, very similar trends there, where you had the blue peaking, huge amounts of supply coming on sale, and then that starting to normalize over time, it going back below average in like 2015. And then we've started to go back up again as the building supply has increased again. But you can see like we're still nowhere near that average point for the blue line. And then likewise for the green line, it goes down going into the recession and then up as we start to recover and back to normalization. And so we were up at the peak levels, and we have come down from those peak levels, but we're kind of up at like the normal levels. We haven't collapsed into like the recessionary levels, whereas this one's actually lower, closer to like the average level together. And so what you can do is, like I said, these are basically two separate markets: housing, this is renting and housing, renting and buying. And there is, technically the possibility to switch between those markets, and that doesn't really capture for that. So what I did then was I said, okay, well, let's combine the two. If you combine both of them together, this is what it paints the picture of. So this is what I would say is sort of like the balance of the total housing market, buying and renting in the United States right now. And likewise, as I said, with the blue line, it shows the vacancies as a percentage of the total occupancies. And so you can see vacancies climbed going into the GFC, which that vacancy was a lot of units that were not moving. And you can see that they have been climbing since the low of 2022, but they are nowhere near the kind of average point of the graph, or whatever normalized point you might want to say on the graph is. I don't know what you want to say is. We're looking on the left here. So maybe 4%, which is where it was in 2000. Maybe that's not normal. Maybe 3.5 is normal, or 3 is normal, or something. I don't know. But you could argue about what it is. But 4 is sort of about what the midpoint is. And you can see like we're at 3.4. So we could theoretically go upward more. This long way to say that we don't have an oversupply. We have geographic specific oversupplies, because this is looking at the whole nation as a whole, and so it doesn't take into account that there's been more building in certain regions than others. So there is region specific oversupply, but as a nation as a whole, relative to the total populations as a whole, we're not really seeing that. That's not really the case. And then likewise, the green line kind of takes the same thing into account for the building. It basically says like how much building is there currently relative to the vacancies currently. And we've had a decline in the buildings relative to the vacancies, but we're actually sort of back to around somewhat of a normalized level. So yeah, like I said, kind of complicated 3 charts there, but I put these together a few months ago, and I was like, okay, I really like these. These are a good way to kind of like get a very comprehensive picture of building, vacancies, and occupancies across both the buyer and renter markets in housing. So that's a long way to say that, like I said, a combination of all of that put together is that, it does look not great out there in a lot of ways for housing. But I think it's a sort of a darkest before dawn kind of scenario where, if you wanted to get in at the bottom of 2010 and 2011 or whatever, you know, you had to accept that it looked real rough out there in the housing market. You know, everyone was telling you it was a disaster out there, and that was the time to buy. And everyone doesn't feel that way because housing prices didn't actually come down this time, obviously, right? Like people don't really feel like we've actually had like we're actually at sort of the trough. But the truth is that, I mean, we potentially probably are. So yeah, that is what it is. And you know, like I said, I'm watching all that very closely because I do think that that's, out of like a lot of my positions, that's probably one of the more sensitive to specific economic bets that I'm making, I would say, kind of stocks I have in here. Like a lot of them are bets on various industries or bets on various companies and stuff like that. But Lennar is very much like, I'm very much making a bet on me being right on this data, essentially. Like, yes, I like Lennar specifically, but it's like at the end of the day, it doesn't matter how nice of a company Lennar is, the stock is gonna underperform if I'm not correct in my my evaluation of the housing market data, broadly speaking. So that is what that is. And you know, related to that is the economic data, which I did do a show last week, by the way. I don't think a lot of people caught it necessarily, but I did do a show last week on economic data, and then I ended up unlisting it because the audio was just garbage. I mentioned that at the start of the show, but it was just terrible. So you know, in some ways I kind of wanted to like cover some of that stuff again, but like specifically a lot of the employment data looks really bad from various points of view. But I do think that that is another situation where it's like it's a little bit more complicated than it seems in some ways, because like you have to take a lot of the immigration changes into account, and if you take the immigration changes into account, it doesn't make the employment situation look good per se. Like it doesn't make our current employment situation look amazing, but what it does do is it makes last year's employment situation look a lot worse, and the year before that potentially even worse as well. And so it's like when you take those things into account, it kind of fits into the other thing I was saying, which is that we were sort of already going through a rolling recession of sorts in like late 22 to early 24 or so. And we in late kind of like mid 24 or so, we maybe were kind of starting to come out of it. And we're still sort of coming out of it in some regards. And so, and like I said, you can see that in a lot of these data series where it's like we weren't in like severe recessionary territory, but we were in kind of like this dawdling negative territory a lot. And I put together a new measure that I like just the other day here that combines labor force participation rate and unemployment rate on the sort of rate of change basis, which I like this one because it hits every recession perfectly. It does have some negative ones that don't hit recession, but it doesn't go to like negative 15 to 20% or something without hitting a recession every time. So that's sort of like the trigger point. And some of them are a bit early too, and not every time, but employment's usually a very lagging economic data point. So the fact that you can get a time series to show you through through unemployment data, show you potentially going into recession even before that, that's pretty impressive. Now it doesn't reach those, like I said, negative 15 and negative 20% points until you're well into the recession. But nonetheless, you could at least say, hey, we're at risk. We're heading that direction. And then, well, hey, I would point to the most recent couple years here and say, well, we were going into negative territory at the end of 2022, and midway through 2024, we hit kind of a bottom and started to move back up. Wow, well, that's the same thing I've said several times already. Crazy, crazy how that works. And you know, like I said, I can show you that in a variety of different ways with different types of data sets that kind of show very similar pictures. So anyway, long story to say that, you know, the economy is not great, but it's also not looking like it's necessarily heading into recession in the next 6 months, I would say, at least. You know, hard to give strong confidence of a forecast beyond that, because, well, the next 6 months of data might give me enough to see some directionality the other direction. So we'll have to wait for that data. But in the short run, things are looking okay, which makes me feel, yeah, sort of good with that bet about housing. Second half of next year, because yeah, I don't think the next 6 months of data is going to change my opinion about that necessarily. I think it will remain consistent. So that means, yeah, we will probably get lower interest rates more solidly into next year, which will also be a boon for FG as well. Oh, actually, that's one other thing I did want to talk about, because I know I've talked about and made the case multiple times on my streams about insurance companies and how they are affected by interest rates. And I think, I think I made like a good case for it in some ways, but I think also it was not necessarily super clear to see. When everyone is shot 10-year treasuries and it's not being used as safe haven, why would there be a recession? I'm not sure what do you mean. Whenever you mean everyone's short treasuries, um, it's not being used as a safe haven. I would say, I mean, it still is being used as a safe haven. It's just not being used as a safe haven as like perfectly and completely as it has at other points in time. It's like it has a little bit of a competition going on for it in terms of how safe haveny is it on any given day. And I think it also depends on the day, depends on the reaction, because bond yields dropped on Friday, for example. So like on Friday, bonds were a safe haven, but not every single dip in this year has that been the case. Like, obviously, like gold's been a better safe haven across the board, generally speaking, this year. But whether or not that's going to be consistently the case is a separate question. Obviously, I am very bullish gold, but still, I don't want to overspeak the treasury's decline. If that's to make my point. So here I have the 10-year spread. Now let's switch to IAK, and then we'll go IAK divided by CPI, and then we will actually also switch it to logarithmic. Yeah, so like on previous streams, I know I was kind of talking a lot about this, and I was kind of trying to describe the relationship of how and technically I kind of want to put the 10-year up as well, just as is, because insurance companies broadly, and this works for annuity companies specifically, do well with a combination of high long-term rates and relatively high yield curve spreads. So difference between long-term and short-term rates. Those factors together are good for their profits, good for their profitability, generally speaking. Put them all on separate. And it can be a little bit hard to see necessarily, and it's not always a perfect fit, because, for example, if you're dropping into a gigantic financial crisis, then that relationship isn't super clean right then and there. But like, for example, if you were kind of just to like start looking at this chart from like 2009 onward, then a lot of that relationship fits very, very well. Whereas basically, generally speaking, like if the green line is going down, it's going to be not as good for the upward movement. But at the same time, if the green line remains flat and then this happens to move down, it can make them move upward together. And then technically speaking, this is just looking at the insurance company itself. It's not technically taking into account the over or underperformance of it. So like I said, I had showed this relationship a couple times on stream previously, and I had even kind of like narrowed in to try to show specific relationships to it. But something that I had done separately in the last month or two was I tried to kind of like go and do a much more thorough analysis of this relationship throughout history. Hold on a second, let me pull it up. Delete that. Okay. So what I went and did is I went to the Fama French data website and downloaded index and industry returns going back to 1926. Because by the way, you can get very specific total return data for like 40 different industries back to 1926 if you know like where the academics like to put their data, stuff like that. And by the way, here's the yield curve also going back to that. Although this isn't the this isn't the 10-2. This is the 10-year 3-month spread because, well, if you want to go back this far, you need to use a different short-term rate. So I use the 3-month. So this is the 10-year 3-month spread, and down here. Basically, what I started doing is I wanted to test that relationship against the total returns and look at it statistically. That's kind of what I did. I was like, well, let's actually look at statistically the relationship between the yield curve and rates generally in that. So that's what I did. Like I actually tested a variety of different parts of the interest rate effect of the relationship. I have like the BAA Moody spread, the AAA Moody spread, the difference between the BAA and AAA Moody spread. So that's kind of like a credit spread difference right there. And then AAA to 10 years also like a credit spread. This is like a high quality credit spread, and this is like a low quality credit spread. And these are like absolute rates of higher or lower quality. 10-year treasury, the 3-month treasury, the difference between those, the CPI rate, as well as the real 3-month CPI, which is basically the 3-month adjusted for CPI. And then I have the M2 money supply growth rates, the inflation adjusted M2 money supply growth rate, GDP per capita, real GDP, or my bad, real GDP and real GDP per capita I meant. And then debt to GDP. This is like government debt to GDP, the population growth rate, the unemployment growth rate, gold's nominal growth rate, the inflation adjusted gold growth rate, oil growth rate, real oil growth rate. And then over here is like the actual industry in question that I'm looking at in the S&P 500, and then the industry relative to the S&P 500. That's like one thing specifically I wanted to do is like, let's actually check the outperformance against the S&P 500. So what I did is I bucketed all the different return areas, because like I said, this is from data from 2025 going back to 1926. And so I basically looked at 5-year periods for all of these. 5-year periods, so like the 5-year period ending in each of these years. So this is the 5-year period ending in 1930, 1935, 1940, 45, so on and so forth. And then for all of them, I just looked at what was the average of each of those metrics for that period. So like the average BAA rate for 1926 to 1930 was 5.7%, whereas 2021 to 2025, it was 5.2%, you know? And then likewise for like the CPI, I used the compounded growth rate over that 5-year period. So, you know, like anything where it was like a stock that was growing or something like a CPI or gold or GDP, we just used what was the compounded growth rate over that period. It's for all these bucketed periods. And then down here, I took a bunch of correlation statistics against all these things. Like I said, what is the correlation and the R squared of the industry itself specifically to each of these metrics, and then what is the S&P 500's correlation to each of those metrics? Because, you know, it's one thing to say, oh, insurance does well when the yield spread is high. But the question is okay, but is that true for the S&P 500 as well, right? Like, it's not that useful to say insurance is going to do well if the S&P 500 does better, right? You kind of want to know that when does insurance do better than the S&P 500? So we checked the insurance, the correlations against insurance, but also the correlations against the S&P 500, and then also the correlations against the insurance versus the S&P 500 ratio for each of those periods. So that kind of gives you an idea. And then the highlighted yellow ones are the ones that I dictated at being a significant enough R squared that it's worth mentioning, which I basically said was like 5% or higher was what I designated as significant enough that it's worth mentioning. So, you know, looking at that, insurance outperforms the S&P 500 when there are high rates generally, high 3-month rates, high 10-year rates, high AAA rates, high BAA rates, all across the board, high rates generally speaking, which is one of the things I said. So there you go. I'll point that out. I was right there. And then also with yield curve spreads, 10 to 3-year yield curve spread. And also I'll point out that the R squared for this one is 21%, which is the highest of all the R squareds for that row, definitely. There are a couple that are slightly higher for the S&P 500, and then there are a couple that are higher over here as well. But for the what causes the insurance to outperform the S&P 500, that is the strongest statistical relationship that we have is the yield curve. So I just want to point out, you know, I wasn't making these things up. It's like I said it because it made sense based off of theory, and then I went and looked at the chart to say, okay, well, I'm pretty sure it'll show up in the chart. And it did show up in the chart, but like I said, like looking at something visually in a chart is one thing, but that doesn't actually tell you things about correlations. A lot of people like to look at things on charts and be like, look at how correlated it is. And it's like, okay, that doesn't necessarily mean it's correlated. Things can look like they're going together and not actually be all that strongly correlated. It's just one of these things that, a lot of people have very, very, I would say, primitive understandings of statistics. A lot of people, for example, what they like to do is they like to look at the correlation between two things, and they'll like look at the correlation of the nominal values between those two things. So they'll be like, oh, gold and the M2 money supply are correlated, which they are. But what they'll do is they'll just take the actual M2 nominal value and the gold nominal value, and they'll run the correlation, and it'll be very high. It'll be like a 90% correlation or something, and they'll be like, see, it's correlated. But it's like, no. What you need is the change in gold and the change in M2, and you need to see if the change in the thing is correlated. And that's like the smart way to do statistics. So, and by the way, when you do that, that's where you end up with saying things like, well, 5% R squared is actually pretty significant, because, well, when you're looking at changes in things, you tend to not see very, very huge relationships. You kind of have to accept that you can only get very minuscule or moderate levels of relationships. So anyway, coming down here to this chart, by the way, because this is actually shows like what those returns actually are. The blue line here is the insurance total returns, and these are total return indexes, by the way. They do include dividends. So here, and then the orange line is the S&P 500 total returns, and then the green line is the insurance relative to the S&P 500. So you can see, like, in general, the story since 1926 has been underperformance, you can see, but it is more complicated than that depending on where you begin and start your points. It underperformed basically since the start of the Great Depression in 1928 down to about like the mid 60s or so. And in the mid 60s or so, it then kind of bottomed till like the mid 70s or so. And then the mid 70s, it started to outperform actually pretty significantly until like the mid aughts or so, 2005 or so, or something like that, where it then had an underperformance period for 10 years and then recovered again in like 2021 before then underperforming again. And I would say, like, that's kind of interesting, because if you look at that yield curve spread, it kind of paints an interesting picture relative to that, where we had a high yield curve spread way back here. Now we have the major underperformance here, which, like I said, whenever you have like an actual financial crisis, the relationship is going to be kind of broken up a little bit. Like, it broke up in 2008, but it also broke up in 1929 as well, where for at least a couple of years that relationship just breaks down, because frankly it's the financial companies that are being worried about. That's like the reason why, is like once the financial companies themselves become the focus, all other relationships just get thrown out the window. So that's why 2008 and 1929, it breaks apart after that. But nonetheless, after that, yes, we had a high yield curve here in the 30s, but it was on a continual downward decline all the way till the mid 60s. So, which, like I said, the higher this is, the better it is for profits of it. So we had a continual downward movement in the potential profitability of insurance companies. And also, you'll see how stable the relationship it is relative to over here. There's a reason for that. And that's because there were all sorts of regulations put in place during the Great Depression that basically forced banks and insurance companies, we're looking at the insurance companies specifically, but financial companies broadly, were forced to hold various treasuries in various amounts, and also had various limitations on the interest rates that they could charge their customers. So basically there was all sorts of regulations that were severely limiting the profitability of these types of companies. And so the combination of those things created this massive outperformance. But it was also a downward trend, where the downward trend technically bottoms here around like 1980 or so, but you can see it was sort of getting close to its bottom also in that like late 60s, early 70s timeframe, which is around that period where the industry itself started to bottom and then start to edge a little bit higher. Now it starts to really be more of a moving sideways kind of thing, but I'll point out that generally speaking, it was still kind of at least stably no longer heading towards negative territory where it was in the 70s. So it's one of the reasons it caused this outperformance. So I just want to show it's like that relationship I've talked about with the interest rates and insurance is like, I had been talking about it a few different times in a very kind of limited time frame here, just talking about this like 10 to 15 year period and looking at that data. but it holds pretty strongly if you look at 100 years of data. You look at 100 years of data, it works out pretty well. Now, the fun part about this, by the way, is that, like I said, I did this whole analysis because I wanted to kind of confirm what I had been saying. I wanted to like go back through the deep history and confirm that it was not only true in the last 10 to 15 years, but that it was just true generally speaking. And I was happy with the results, but it occurred to me that the spreadsheet I had made was very easy to use for other purposes because I had kind of laid all this information out up here. In fact, because I didn't start with all this information, I started with just the bond information. But then once I realized how useful this was going to be, I expanded it to include all these other things here because I was like, well, why don't I do this for other industries? Since like I said, the same data set I was looking at had like 40 different industries that you could look at. So I was like, well, why don't I look at other stuff? For example, I have a lot of exposure to gold miners. So why don't I look at the same thing with gold mining industry data, which I have right here. So, and unfortunately, I only have the gold mining data going back to the 60s. So it's a little bit less of a complete data set. And here I'm still showing the yield curve because I just didn't change this, just didn't change that out. But it's not as relevant, frankly. The bonds you'll see are not as relevant. But what is relevant for gold mining returns is the 3-month treasury adjusted for inflation, the inflation rate itself, the M2 money supply growth, the population growth rate, which it's actually negatively correlated with, which actually I should have mentioned that it's negatively correlated with the real 3-month treasury rate, which is one of the stereotypical things, by the way, people have always said about gold is that it is correlated with negative real rates, negatively correlated with negative real rates. And that's what you see right here. And then it's also negatively correlated with unemployment, which means like gold goes up when there's recessions, by the way, like you can see it right here in the data. And then the real gold price. So gold miners do in fact go up when the real gold price goes up, which you would expect, but you can see right here, it is strongly true. And they're also correlated with oil prices, which makes sense because oil is actually a very significant input to mining operations. And gold miners are negatively correlated with S&P 500 total returns. So that's an interesting thing right there. And then also that's the absolute industry returns. So obviously then there's the industry outperformance, which is a lot of the same stuff. You can see like most of them are the same, but industry outperformance also occurs with real GDP negative correlation. So with gold miners are likely to outperform the S&P 500 when GDP is low or negative is basically what that implies. And then low or negative real GDP per capita as well is basically what that is there too. So, like I said, I was like, why not test this with gold mining companies and you see how much the relationships you expect to exist actually exist in the data. And it turns out that it is pretty strong. And I did this with more than just those two. I was like, well, why stop there? We can keep doing this with lots of stuff. I did this with the construction industry, which the data set I was looking at didn't have a home builders indices. They just had this construction one. This construction one, it includes home builders because it's going by NAICS codes designations of construction. So this was basically the closest I was going to get to be able to testing the relationships for home builders. But here, a lot of those relationships also make sense. There is a strong relationship for interest rates, but it's a negative correlation. So low rates is good for home builders is basically what it means. Low credit rates, BAA, not risk-free rates, but like actual credit rates. And then the credit spread too. So BAA versus AAA, which is like saying like a slightly lower credit score versus a higher credit score, also negatively correlated to a significant degree. Negatively correlated with real 3-month rates, which is the same as gold. Strongly positively correlated with inflation, positively correlated with money supply growth, positively correlated with real GDP growth and GDP per capita growth, negatively correlated with debt to GDP, which is kind of interesting. Positively correlated with the S&P 500, and that's the absolute returns. Like I said, you can see the relative returns is a lot of the same stuff, but then there ends up being like a couple deviations. So the point is, like, I did this for like a dozen different industries. I did it for medical equipment, I did it for guns, I did it for electrical equipment, I did it for real estate, mines, utilities, drugs, banks, oil, like I said, gold miners, construction, and insurance. Kind of looking broadly across not just the industries that I have, but a lot of the ones that I like. And the truth is that a lot of like I said, the kind of stereotypical stuff that people say is true. A lot of it is true at the end of the day. But nonetheless, I am a data person, so I do like to go and actually check a lot of these things. Again, it gives me more confidence because, like I said, getting back to kind of, we got on this train when I was talking, talking about the insurance thing, but I was also talking about housing, in saying that Lennar is kind of what I would say is probably the most economically sensitive out of all of my positions. And so it's like, I am in some ways betting a little bit big on the take that yes, our economy is weak, but it's not recessionary. And the housing play is pretty key on that, because we need a non-recessionary environment that eventually turns into a liquidity environment, a money printing environment, which is basically the environment I think we're in. I think we're in essentially a somewhat liquid tight environment currently that is going to slowly but surely transform into a more liquid environment over the next like 2 years or so, as we get the changeovers in the Fed, lowering of interest rates, but also the ending of quantitative tightening and potentially eventually resuming of quantitative easing. Also, certain stimulus parts of the one big beautiful bill should start to really enter the economy going into the first half of next year. Because I think a lot of people were focused more on like the deficit impacts of the one big beautiful bill and some of the like cost reduction impacts to the benefits programs, but there was also plenty of like stimulatory factors that were just going to take some time to enter the economy. Specifically, they were going to take almost a year. So first half of next year is when that stuff was going to come in. So positive, kind of like a positive fiscal impulse in terms of like stimulation to the economy. So point is next year, there's a lot of reasons to believe that next year should be reasonably positive for the economy and in a variety of ways. Probably won't be an amazing year, but it should at least be a reasonably positive year. So yeah, that should be good for Lennar, and that should also be good for FG. Like I said, I had previously said that, in my opinion, one of the only serious concerns for FG was that if we were to have a serious recession where there was going to be concerns about their balance sheet. Like I had said that many times before, that it was like, frankly, the inability to really be certain about the quality of the balance sheet, other than just looking at the limited history they have and trusting the management due to what due diligence I've done to them. Outside of that, there isn't a whole lot of like super specific reasons to look at the balance sheet and say, yes, I know for a fact that that's a good balance sheet. You sort of have to say, there's no reason to think it's bad. And then here, this in, like I said, these last couple of weeks, we finally have gotten these concerns about the private credit assets and stuff like that. So I will be, like I said, looking closely and waiting for that the earnings call on the 5th. And then Blackstone's is before that. It's this week, next week. I'm looking at weeks, that's why. Yeah, so October 23rd, 10 days from now, we'll get Blackstone's call. I will probably be listening to a whole bunch of those, the private equity guys' calls, but especially Blackstone. I mean, I always listen to Blackstone because of FG, but now especially I'll be listening closely. But listening closely to the other ones and doing some research into the other ones. And then, yeah. But that's going to do it, I think, for today. It's been a fun little chat. Like I said, a little bit of a smorgasbord of stuff to talk about. Talk about gold, talk about private credit, talk about FG, talk about housing, talk about data. But yeah, so it's been doing pretty good. As I had said a couple times on the stream, I did do a show last week. So that's two shows in 2 weeks. That's a little bit more regular than normal, even though, like I said, I did have to unlist the other show because the audio was so bad. But I am trying to get back to a more of a regular schedule. So hopefully, maybe not next week, because my regular schedule I'm trying to keep to is more like every other week. So hopefully, theoretically, I'll have another show in 2 weeks' time. I definitely have plenty of things I could talk about, the little projects and stuff that I've worked on this year that I haven't actually talked about at all on stream. So there's plenty of stuff we could talk about in the future. Just need to get better in my own private life about having a better kind of regularity to my weekend schedule. That's really the situation there. But yeah, so catch you all next time. Bye.